Welcome to the final part three of our overview of security types. And in this part three, we'll be talking about options. Again, this is Dr. Kent Gregory, and I'll be following the Fundamentals of Investments, the ninth edition, published by McGraw-Hill in 2020, authored by Jordan, Miller, and Dolvin. So we've already covered interest-bearing assets, equities, and the first part of derivatives, futures. So now we'll go on to the second part and our final part of our discussion totally, but the second part of derivatives, about options contracts. So options contracts, definition in one short phrase. An option contract is an agreement that gives the owner the right, but not the obligation, to buy or sell a specific asset at a specified price for a set period of time. And again, this is a right but not an obligation, and then everything else is specified. So there are two types of options. There's the call option and the put. So with a call, the owner has the right but not the obligation to buy or call an underlying asset at a fixed price for a specified time. On the other hand, a put option, the owner has the right but not the obligation to sell an underlying asset at a fixed price for a specified time. So some further definitions and notes and terms that are used with respect to options contracts. So the option premium, this is the price that you pay to purchase an option. The strike price, also known as the striking price or exercising price, is the specified price at which an option can be bought or sold. Exercising the option means using the option to buy or sell the asset. And the last trading day for all monthly stock options in the United States is the third Friday of the option's expiration month, or the third Thursday if the Friday is a holiday. The expiration day for stock options is the Saturday immediately following the last trading day. So also the expiration day is the last day that an option can be exercised. So differences between options and futures. So with respect to obligations, the purchaser of a futures contract is obligated to buy the underlying asset at the specified price, and the seller is obligated to sell. However, the owner of a call option has the right, but not the obligation to buy. This is just repeating a little bit of what we said in the previous slide. The initial payment or premium on a futures contract, the purchaser pays no money at the time of purchase, and the seller receives none at the time of purchase. However, the purchaser of an option contract pays a premium at the time of purchase, and the seller receives the premium at the time of that purchase or sale. So option price quotes. Most options contracts, like futures contracts, are standardized. The one call option contract gives the owner the right to buy 100 shares, also known as one round lot. So 100 shares or one option is one round lot. To get option prices, you can go to finance.yahoo.com, enter a ticker symbol. For example, for Nike, NKE is the ticker symbol, and this is from the textbook. And then you click on the options link once you've pulled up that stock. And this is an example where we're going to talk about gains and losses. And this particular example is example 3.4 from the ninth edition of Strategic Investments. And it talks about put options. So suppose you want the right to sell 200 shares of Nike at a price of $65. Since you want to sell, you want to buy put options. And since you want the right to sell 200 shares, you want two contracts. Remember, each contract represents 100 shares. So specifically, you want to buy two 65 put contracts. In the table, for example, in example 3.4, or preceding example 3.4, the price for this contract is given as 28 cents. So this is the price per share. So one contract would cost you $28. So 100 shares times 28 cents. Well, two contracts would cost you $56. So 2 times 100 shares times 28 cents. As with futures, options contracts have the potential for large gains and losses. So consider example 3.4 above and in your textbook. So you bought two Nike 65 contracts for $56. Suppose the expiration date arrives and Nike is selling for $45. Well, how'd you do? What's the break-even stock price, i.e. the stock price at which you make just enough to cover your $56 cost? So that's two questions there. How'd you do and what's the break-even stock price? So your put contracts give you the right to sell the 200 shares of Nike at $65 per share. If the stock is only worth $45, but you have the right to sell for $65 per share, your put options are worth $20 per share, or $4,000. So this is $20 times 200 shares. The break-even stock price is thus $65 minus the 28 cents, which equals $64.72. So at any price below $64.72, the buyer of the $65 put option would make money. So here's another option, another example, I should say. So let's say you have $15,000 to invest. You're looking to purchase Visa, which is selling for $150 per share. And again, this example is coming from your book. You notice that a call option with our $150 strike price and 3 months to maturity is available for a premium of $10. You want to invest the full $15,000 either into the stock or into the call options. What is your return from each scenario if in 3 months Visa is selling for $165 per share? What if it's selling for $135 per share? So if you buy the stock, your $15,000 will get you one round lot, i.e. 100 shares. So 100 times 150 equals 15,000. A call contract costs $1,000. So 100 shares times the $10 premium. So you can buy 15 of them. Sorry, I left out the word buy, but you can buy 15 of them. And note that your 15 call contracts gives you the right to buy 1,500 shares. So 15 times the 100 shares in each lot at $150 per share. So if you bought the stock, in 3 months, Visa is selling for $165. Your stock would be worth 100 shares times 165, which gives $16,500. Your dollar gain, i.e. the return, is $16,500 minus the $15,000, which results in $1,500. So your percentage return is $1,500 divided by 15,000, which results in a 10% return. Now, if Visa is selling for $135, your stock would be worth 100 shares times 135, which would give you $13,500. Your dollar loss here, so your return, is 15,000 minus or 13,500. I'm sorry, this should be reversed. So it should be 13,500 minus the 15,000, which would give you a negative 1,500. Again, my apologies for my mistake. So your return is that negative 1,500 divided by the 15,000. So it's a negative 10%. So again, I apologize for my typos and mistakes, but hopefully it's clear now. Now, if you bought the call options, if Visa is selling for $165, your call options are worth $165 minus $150, which equals $15 each. But you now control 1,500 shares. So 15 contracts times 100 shares. So that's 1,500 shares. So your options are worth 1,500 shares times $15, which results in 22,500. So your dollar return works out to be $7,500, much more than if you had bought the stock. Your percentage return is 50%. Now, if Visa is selling for $135, you actually lose everything, and your return is a negative 100%. So 135 minus 150 equals negative 15. Put returns. So in our Visa example, let's say you have the $15,000 to invest, and there's also a put option with a strike price of $150, which has a premium of $7.50. So calculate your percentage return for the 3-month holding period if the stock declines to 141 per share. What is your annualized return? So one contract, so a contract equals 100 shares, costs $750. 100 times $7.50. So you can buy 20 of them. So 20 times 750 equals 15,000. So we did this on purpose, or rather the book did that on purpose to give you some round numbers. So note that your 20 contracts gives you the right to sell 2,000 shares. So 20 contracts times 100 shares per contract at $150 per share. If in 3 months Visa is selling for $141, your put options are going to be worth $9 each. You control now 2,000 shares, so your options are worth 2,000 shares times $9, which gives you $18,000 total. You invested $15,000, your dollar return works out to be $3,000, and your percentage return is 20%. So to annualize your return, we need to compute the effective annual return, the EAR, and note that there are 4 3-month periods and 1 year. So 1 plus EAR equals 1.2 to the 4th. Those are your 4 periods, which works out to be 2.0736. And then if we equalize everything, the EAR works out to be 107.36%. Well, thank you for joining me for this and listening, and I hope you enjoyed it and that you understand it. Until the next time, take care.